Welcome back. Let's focus on the auto space now. Samvardhan Motherson, which is the erstwhile Motherson Sumi Limited, has acquired the assets of frame manufacturing and assembly operations of Daimler India commercial vehicles. Vivek Chand Sehgal, who's the chairman at Samvardhan Motherson International, joins us now to talk about that. Mr. Sehgal, good morning and thanks a lot for joining us. Plenty of questions, but first on this particular acquisition, what are the synergies, and if you can just tell us how much would this help you increase your content per vehicle?
Well, this is something which is ongoing with Daimler worldwide. We acquired cold stamping and a company which was supporting Daimler in India. And this is the next step. We are taking over the frame manufacturing and the long member manufacturing of Daimler. The turnover last year was approximately about 300 crores. And this particular thing augurs very well, because for next 10 years, we are going to be working together as a sole supplier to Daimler. And we could also then use the assets for other consumers in and around Chennai.
Okay.
So
this,
yes.
Sure. This acquisition, you've said, has a 300 crore revenue potential. When does this 300 crores kick in? I mean, over what time period?
So we were doing contract manufacturing for them in the last year, and now it becomes a full supplier.
So how does that change the revenue potential for you? So from being a contract manufacturer, now you're a full supplier, and you can use this to supply to other OEMs as well. Does that mean a big, big revenue potential? If you can in some way quantify it for us, are you in talks with other OEMs to supply to them from this factory?
At this moment, I think it was important for us to do the deal with Daimler. Now that it becomes a part of Motherson, we can do more business with outside customers if required. But just to give you a size of the order book was what I was trying to do.
Sorry, what did you say?
Sorry?
What did you say was the size of the order book?
Well, it's about 300 crores for the last year. But as it goes forward, it's going to be better and better.
Okay, so on a compounded basis, what could the growth look like?
This is too small in this acquisition.
Yes.
It's important for us because it opens up brand new avenue, body in white, then these kind of metal this thing. It augurs very well for the entire content per car and trucks, etc.
Any other OEMs where you are, supplying to the facility, and perhaps you plan to integrate in future? Any more acquisitions of this sort that you're looking at?
So, Sonia, we've just done a deal with Saudi Arabia for cars and all that. You know about that.
Yes.
So all these things are strengths that are being built up in Motherson Group. Then we can go into different countries and we can solve their problems, whatever the customers that are there, we can do that. So it's very important for us. And when you have Daimler as a teacher, it's amazing what we can learn and what we can contribute to the world.
Can you quantify for us this Saudi Arabia deal? You've said in the press release that you're looking to evaluate opportunities for industrial development and service activities. What would this entail, and what kind of revenue potential would you be looking at here?
I think revenue and all that is vital, but we have to set up the entire ecosystem of manufacturing vehicles, whatever parts that we manufacture. So we are going to transfer that particular know-how on to Saudi Arabia and potentially one or two other countries. So the ability for those countries to make their cars, which they want to make, their national cars, whichever, is the opportunity. And the investments and all could really be sizable. So working together with the government and building up the ecosystem for manufacturing of cars, the parts that we manufacture.
Got that. The one thing that has been a bit of a concern to the street, Mr. Sehgal, is the rising debt. So I was going through your last presentation where you said that your net debt has now risen to almost 8,270 crores, and the debt to EBITDA is the highest that you've seen in the last many quarters at 2.1 times. I understand that there has been a higher working capital pressure because of the current challenging environment. But do you think your debt can escalate further in this fiscal year? And if yes, how do you plan to control it?
So I don't really worry too much about the debt in the books because this is exceptional circumstances in the world. And in fact, it is more beneficial when you are having higher inventories because the currency movement and all that doesn't affect you to the negative. So I think, yeah, these are certain very challenging times in the world. But higher inventory is something which the customer is already paying you for, and he wants you to build inventory. So it doesn't really bother us very much on that. And the moment these things ease up, the semiconductor and the other issues, I think you will find that our inventory will come down back to normal. So not really very worried about it.
You're not worried about it, but my question was more to the tune of, will your debt escalate in the near future as your, capex plans fructify? Are we looking at higher debt from the company?
No, I don't think it'll be very high. And look, we always have the avenues of, increasing the equity in the company. We're quite comfortable in that situation. But I believe that we don't see a need for that in the coming next 6 months to 1 year. But if some big acquisition comes, then we will have all the avenues open for us, and including increase of equity.
There's no big acquisition that you're looking at the moment, right?
Sorry?
There's no big acquisition that you are looking at or you've narrowed down on at the moment?
Well, you'll be kept informed as they happen, because there are a lot of things which are happening, which is we can't tell you just now. But there are a lot of cards which are open, and a lot of due diligence is going on, and we are sure that there's going to be that much more. Because our target is very clear.
Okay. One last question from my end. On the margin pressures, because we've seen the margins move to multi-quarter lows of 6.5% because of raw material cost pressures. But now that raw material costs have fallen and things have improved, how much do you see the margins recover to over the next couple of quarters?
So that advantage is, thanks for clarifying, that advantage will come to us. But even the past money that has been spent is being recovered from the customer. Motherson follows the mercantile system in which whatever is the cost, we take 100% of it upfront. And whatever is expected to come from the customers, we don't make a provision for that. We actually, when the money comes in, we will quantify and tell you that much money has come. So I think in that sense, it's a very transparent, clear way of telling all our investors that the money is going to come, but when it comes, that's the time when we will declare it in our results.
All right, Mr. Sehgal, thank you very much. Great speaking with you, sir. And good luck with all of that. Appreciate you joining us here on the program on CNBC-TV18. The markets, firing away. The Bank Nifty is now behaving itself. It did see a sharp turn down, but that has also now come up. The Nifty itself, of course, is at the day's highest point, 116 points higher. Look at what the Bank Nifty did. It went into the red at about 9:30, and it's bounced back, almost back to where it started. So 150 odd points, that's 1/3% on the Nifty Bank. So the move on the market absolutely continues. And of course, the discussion on what's leading to this move is also on. One of the factors, of course, is flows. We've talked about foreign flows and how maybe India is benefiting disproportionately as compared to emerging markets. We've discussed that in detail. But what about local flows into mutual funds? That's basically what we're going to be talking about next. Now, mutual fund flows have seen net outflows from equity schemes. This is, I mean, if you exclude arbitrage and exclude SIPs, and the outflows have actually widened quite a bit. In the month of July, there was about 2,000 crores. In the month of August, that has gone up quite significantly. As I said, this is ex-arbitrage and ex-SIP flows. We've got two gentlemen joining us right now to tell us more. Swaroop Mohanty is CEO at Mirai Asset Management. And we have Manoj Nagpal, Managing Director and CEO at Outlook Asia Capital. Gentlemen, great to have both of you here. Thank you very much for your time. Swaroop, if I can start by asking you to comment on exactly that data. Net outflows from equity schemes widening significantly in August over July.
Yeah, thank you so much for having me. But yeah, I think you're right. What has happened is over the last 2-3 months in particular, there is one segment of the market which is not believing in the long-termness or is taking a short-term call on the levels of the market. And that's natural because when you look at the data points surrounding you and the market having a very significant short-term run-up, some part of the market will believe that it's time to get out, and that's what is happening. So if you look at the broad numbers of equity in particular, the gross purchase of around 25 to 27,000 crores per month is intact. What has happened, and that's what is playing out, is that the redemptions have gone up. And we are being saved by the large SIP book, which continues to rise month on month. So here's the thing, the investor is behaving very differently when it comes to investing through the SIP route and is just behaving the other way when it comes to investing in the lump sum route, and that is playing out.
Okay. Manoj Nagpal is also with us. Manoj, that's the basic question, right? Why are equity flows falling at a time when the markets are outperforming, especially outperforming global markets in a big way? What do you think is spooking investors?
Oh, well, Sonia, the way I look at it is that, the Indian investor, especially the younger lot who's joining the mutual fund industry, is a very educated or a little more financially literate kind of a, investor. So if you see the trend over the last 3 years, whether it was March 2020 when the markets fell, and that was one of the months where a lot of money flew into equity schemes. And as the market started rising, and whenever there is a rally, they are taking profits off the table and putting it back into the markets through the SIP route. So that is one of the reasons you are seeing the SIP book building up consistently. So for example, 3 years back, if you had gone, the SIP book was around 7,000 to 8,000 crores a month. Today, it is between 12 to 13,000 crores a month. So that's a 50% increase in the SIP book. And that's a very good long-term trend, from the investor perspective, because they are committing for the long term, they are committing month on month in a disciplined manner, and taking off profits off the table when they feel uncomfortable of the levels of the market. So I think those are the two big trends that are, actually building the industry for a better long-term run.
Okay, that point I get, that the SIP culture is improving, and that's always a good thing. But my question was more overall, why are the flows slipping? And Swaroop, I wanted to get you in on this. Within equities also, if you look at it, the bulk of the flows that are coming in are due to NFOs. So the question is the same money being churned in the market?
Yeah, one will suspect that some amount of it would be going into NFOs, but out of the 27,000 crores of gross, say 12,500 crores is, say, SIP, and the NFOs are just 3,000 crores. So it's not a significant amount yet. But just to answer your question, there are different types of investors in the market, and there should be different types of investor for the market to function. Actually, when there is a seller in the market, there should be a buyer, and that's how the market functions. So at some point of time, people will take a call, and there was enough money, like Manoj pointed out, which had come in at the past. And if the market sees a significant short-term run-up, this is how some investors behave, and it's not a new pattern which is emerging at this moment.
Yeah, Swaroop, just to prod on that point, which you first said, they're behaving differently. The discretionary lump sum they seem to be going out. There seem to be outflows there, but SIP investors are coming in. There was also the fact that new account openings have risen. I think the size of SIPs have also are becoming smaller. I mean, actually, they may be also a good thing perhaps for the long run because they may be more stickier. But could one also interpret this as some of the sort of, more seasoned investors booking out, whereas a new crop is coming in? Is that could that also be true?
No, difficult to sort of pinpoint which part is going out, but there's no doubt or debate that the penetration is growing. Today on the PAN card, our penetration is around 8%, which was some 4% 2-3 years ago, which Manoj was talking about. Just look at the SIP book from 7,000 to 12,500. And it's a fact that the demography of India is playing out in this market as we speak. The young have started investing, and the young, it's good to say that, they're investing with a plan. And when they invest, the SIPs, they go to be heavier. Hence, there is a lot of shift towards the investing through the SIP route, which augurs very well for participation in the market and staying put in the market. And that's what creates wealth over a period of time. So that is happening as we speak. But some part, irrespective of age, will be in this category, which will look at short-term targets or markets or whichever way. And again, I repeat on the fact that the market had not run up in such a short-term manner, 20% off almost in last 2-3 months, we wouldn't have seen this behavior. Prior to that, they were staying put is a reality.
Okay. Manoj, I wanted your thoughts on, within the funds, hybrid funds have seen outflows, particularly arbitrage funds. Why is that?
Yeah, so there are, arbitrage is more of a parking place, for short-term investment. So people typically tend to invest there just to, as an alternative to debt rather than actually in a hybrid fund. So that's one. That is a category which is, sees large outflows and large inflows over a short period of times, depending on what is the spread on the futures and options, and the underlying cash. So spreads have been shrinking. So if you really see the spreads in this segment have come down to around 0.3% on a monthly basis, which is not really lucrative given where the GSEC yields are currently. And that is one of the reasons there is profit booking happening from the arbitrage fund and going over to traditional debt. But Sonia, one of the other big trends I would like to highlight to you within the hybrid category is the dynamic asset allocation funds, or which are popularly known as balanced advantage funds. Now, that is a category that has become the largest category across the equity space and the hybrid space. So it's almost now 2 lakh crores. Now, this is a category which investors are using as a quasi-equity to enter into the markets and letting the fund manager decide how much to allocate into equity. Now, considering that the size of this category, the balanced advantage funds, has become almost 2 lakh crores, out of which around 40% is invested into equity. So around 75 to 80,000 crores is invested into equities. And the bulk of the balance, 1,20,000 crores, which is currently in this category, is waiting to be deployed in a staggered manner over a period of time. So that is one pool of money that is lying with the mutual funds, which will buy every dip. And that is one of the reasons, mutual funds today, you see, turn a big buyer whenever there is a significant dip that's going on. So that is one trend that is outside of the flows, but contributes to the, buying in month-on-month basis into the equity markets, which people tend to miss out, as a section to look at.
All right. It's great speaking with both of you. Swaroop and Manoj, appreciate you joining in on the program. Thank you very much for some of those insights right now today. Well, 118 points right now on the index, so 17,952 is where we are at. Market breadth, I think, is looking super strong. 1,600 stocks are higher, 500 stocks are lower. So easy 3:1 in advances to declines at this point in time. It's all up kind of a day. That sell-off in Bank Nifty has been reversed. IT is continuing to do well. Metals are participating. And of course, as I pointed out earlier, the small cap index is doing just fine. We'll take a break here. We'll come back. Mitesh Thakkar joins in for some technical trading ideas. Stay tuned.
Welcome back. Well, the market continues to look very strong. The Nifty is now eyeing 18,000 once again. The problem, of course, is that every time you go there, there's perhaps some algo trades which play out. So whether this time we'll take out 18,000 or not, we'll find out soon enough. Look at the broader market. The advanced decline at 3:1. Mid-cap index up over 0.5%. And the Bank Nifty as well has reversed that first hour loss. So now it's all guns blazing for the market. Of course, IT still remains the top contributor. Mitesh is back with us. Mitesh, been a very strong first hour. The dip getting bought on the financials, and the Nifty has been strong through the morning. Your thoughts and your 10 a.m. calls now?
Yeah, So not much better than what the SGX was indicating or what even we were expecting. But I think it's clearly IT, which I've been talking about, remains the area of focus for short-term traders. I think very good breakouts happening on the Nifty, IT, and a lot of IT stocks on the upside. And I think that's where the momentum will be for next few days, even if there's an odd day of profit booking, because we've had nearly now about 4 days of rally in IT stocks. I have a buy on Wipro, which has been a buy earlier as well, but I think even now can be bought afresh. Keep a stop below levels of 416. Look for targets of 435 to begin with. And UPL or United Phosphorus is the stock which appears to be breaking out of a consolidation. That's a buy with a stop at 745 for targets of 780.
Mitesh, thanks a lot for those calls. We'll talk to you in closing bell now. For now, let's move on then and address the commodity markets. Manisha Gupta is joining in for that. Manisha, hi, good morning.
Morning, Anuj. Thank you for that. I'm looking at the cotton prices right now because we have seen a bit of a pullback in the international markets and the Indian prices as well. But even before I get to that, I want to tell you that this pullback is coming in after a very sharp decline that we've seen in case of cotton prices. We're down by nearly 25% from the highs of 2022. We did see an all-time highs of nearly 50,000 rupees per bale in the month of March and April. From there, we're trading at around 36,000 rupees on your screen, as you can see. For the international markets as well, we did see 11-year highs in this year itself at around $157 there, but at current prices we're trading at around 110 or thereabout. We did see a low of 94 onto that one as well. The reason that you have seen a decline in cotton prices because we have seen sowing gain up by 8%. If you look at the graph on how we've done in sense of sowing as compared to last year, 11.7 million hectares last year to 12.6 million hectares in this year until now. So we are looking at a stronger crop right now. There have been concerns because of erratic rainfall, some diseases on cotton crop in Punjab and Haryana as well. The yield also could be on the lower side, but at this point in time, with the kind of rainfall that we are seeing in the month of September, it actually is a positive. So last year was 315 lakh bales. This year, the expectation is that you're looking at a much higher crop at 350 lakh bales. But the only thing is that the new crop will start coming into the markets by the end of October and November. So there is still some time. And until then, the demand seems to be slightly getting better. Also, it is the festival season. So the textile industry seems to be looking at stronger demand as well in the international markets as well because of the floods in Pakistan and because we're looking at a lower crop this time around in US and China as well. The Indian cotton seems to be slightly positive. Even after a 25% correction that we've seen from the highs in this year, we still are in the premium in the international markets is the reason the exports have continued to suffer as well. So the premium as of now stands between 10 to 15% as compared to international markets. As I said, the festival demand is looking strong as we are into festivities and wedding season is not too far away. So the textile industry and cotton demand are expected to see some support.
Okay, thanks a lot for that, Manisha. That's the commodity space. But guess what? The stocks that are charging away right now are the multiplex stocks. And surprise, surprise, Brahmastra has had terrific box office collections contrary to expectations. Vahishta is here to tell us more about that. Vahishta, over to you.
Hi, thanks for that, Sonia. Well, Brahmastra has brought a sigh of relief to the film exhibition industry for sure. And the industry, as we know, has been faltering since many months due to weak content and hence lesser footfalls for the film theatres. Now, Brahmastra's domestic lifetime collections have crossed 100 crores, while the worldwide gross collections have been in excess of 200 crores already. The movie has received some mixed responses. It has also received some negative reviews. But all in all, looks like a good for the film fraternity as a whole. The footfalls over the first weekend of the movie release were actually stronger than expected. Now, what has helped this is the high ticket prices, were definitely at the elevated levels. There was a strong marketing for the film, differentiated content with the VFX effects, and a strong star cast. So now, in terms of some big movie lineups which we have for September, we primarily have the Woman King and Vikram Vedha. But Vikram Vedha is expected to be releasing on the 30th of September, which is towards the end of this month, and hence the collections would flow in Q3. So in Q2, probably Brahmastra is the only hope that we have. In terms of content, we probably will have to wait and watch for more.
Okay, so passing the 100 crore mark on the first weekend itself for the sake of the film fraternity and the industry.
Well, Morgan Stanley is expecting a capex boom. That's a big headline. It expects India's investment rate, that is the percentage of our GDP that we invest, to rise to 36% of GDP. And that's, last year's investment was 31%. And at 36, it would be the highest since FY 12-13. Now, why do they see a capex boom? One, because balance sheets of companies and banks are at their best in a decade. We know much of this, but the numbers are a bit startling. Corporate debt to GDP is the lowest in 15 years, according to Morgan Stanley data. And bank NPAs are at their lowest in 10 years. We know that well. But from the demand side, they have interesting data. Companies, they say, are running out of capacity. Capacity utilization, as the governor pointed out, RBI governor, is running at 75.3. This is the long-term 10-year average is, about 74.5. So it's running higher than that, and therefore people will invest. Also, government policies like PLI, production-linked incentives, and corporate tax cuts are things that goad private sector to do capex, while government's own capital expenditure in the current budget, FY23 budget, stands at 2.9% of GDP. This is the highest in 18 years. Thanks to this capex boom, Morgan Stanley is expecting bank loan growth to rise to 16% next year, FY24, and to 17% in FY25. This again would be some decadal high. The last time we were at these levels was in 2013. Morgan Stanley expects higher investment to kickstart a virtuous cycle of, higher investment, therefore higher profits. Higher profits lead to higher investments again, higher wages and consumption. Typically, corporate profits as a percentage of GDP rise during such a capex cycle, and Morgan Stanley expects corporate profits to grow at a CAGR, compound annual growth rate, of 25% for the next 4 years. Now, which means that currently we are all saying, 20 times valuation of India. That's not expensive. If you're growing at 25% for 4 years, we would actually be only 7x in 4 years. That's the MS calculation. Risks to this forecast, very important. The first risk really is global recession. If the world slips into a recession, or if there is a very sharp spike in commodity prices due to supply dislocations, war, etc., that could lead to higher interest rates and tightening of financial conditions. But still, their base case is a capex boom. To decode more about this, Upasana Chachra, Chief India Economist at Morgan Stanley, joins us now. Upasana, thank you very much. We've been receiving some really bullish reports. And we can see that in the stock markets, we are Nifty outperforming NASDAQ this year by like 17%. It's a huge outperformance. So, there are lots of people who are looking at the economy positively. But a capex boom is, something we have not heard. How do you support your argument?
Hi, Lata. So I think as you started off in your opening comments, you've summarized it pretty well. We are looking at a synchronization of the supply side and the demand side factors coming together this time. And we think this will lead to a secular rise in the investment to GDP ratios. So on the supply side, the balance sheets of corporates or banks is the best in nearly 10 to 15 years. Corporate debt is at, in terms of numbers, at 47% of GDP, down from the peak of 62%. So there's a lot of deleveraging that has already happened. On the bank side, impaired loans are tracking at 10-year lows. And alongside, we've seen this whole shift from the government policy in terms of, taking actions which support investment growth higher. So the corporate tax rate reduction or the production-linked incentive schemes. There's definitely intention to push investments higher alongside what the government is doing through its own balance sheet in terms of public infrastructure spending going higher. So we think that this will all culminate alongside the demand side factors. So on the demand side, we are seeing domestic demand indicators remaining very strong. All the high frequency data points like GST collections, PMIs, etc., are all gaining strength and holding on to that. And I think even the GDP data that we got for the June quarter was below expectations, but the domestic demand story over there, like especially private consumption, did show that it has seen a smart recovery in the last quarter. That alongside the sentiment for India, like our strategist also has the MNC sentiment index, which is tracking at an all-time high. So I think there's this culmination of factors coming together, which makes us constructive on the capex outlook. So yes, in terms of numbers, as you put it out there, we are expecting capex to GDP to rise to 36% by fiscal 27. So that will be like capex compounding at close to 16.5% in the next 5 years.
Yeah, Upasana, I agree. I stole the thunder by presenting your report because I thought viewers will better appreciate your argument. But let me present the counter now. You've spoken about the risk to coming from global indicators. Now, the global indicators can be very severe. After all, people are forecasting that US and Europe could enter recessionary conditions. And already we are seeing Indian IT companies saying that variable pay will not be paid as they originally promised. If you looked at August auto sales, they've all done well domestically. Their Bajaj Auto, all of them reported very poor export sales. So this can be a big dent to the capex expectation, you think?
Fair enough. Exports have slowed definitely. So the export numbers for August were weak, and we are seeing that in other countries' data trends as well. Our team also expects a recession in Euro area, not so in the US right now. But nevertheless, the global growth environment is weakening, and G10 growth would probably be around 1% as per MS estimates next year. Having said that, I think what's happening on India's export side is also again probably some of these factors that we discussed coming together. So we are seeing an improvement in India's goods export market share. Goods export market share is currently tracking near all-time highs of about 1.9%. It was at the low point around 1.5, 1.6%, and pre-pandemic it was around 1.7 to 1.8 in that range. So we are seeing some amount of offset through export market share gains, I think, which probably the story should continue. And at the same time, I think domestic demand providing an offset will be a bigger support to this thesis going forward. And I think as also the last point here would be that, capex to GDP, yes, rises to around 36% of GDP, but that's below the previous peaks that we saw in the cycle up to the credit crisis, where capex went up to almost 38, 39% of GDP. So I think if anything, if the global growth environment is actually better than what we are penciling in, then, this trend could have been even higher.
Yeah, I mean, it's a little not very convincing because not just exports, but imports have grown far more than exports. So we would continue to have a net export problem. Okay, let me go to the other point that irked me. Government capex. The government is actually, general government debt has gone up seriously because of COVID and even before that. Because of them recognizing, contingent liabilities also as government debt. Now, I was reading a Citi report which points out that about 20 to 25% of government revenue are going to pay interest, which is much higher than what it was pre-COVID. So do you think this capex contribution from the government can continue?
Yeah, so I think if you look at even in the last 2 years and impacted by pandemic as well, the government capex did see an increase, not just in YOY terms, but as percentage of GDP as well.
Central government, not general government.
Yes. Yes, central government. State governments obviously saw a dip in the capex numbers, and given where they were in terms of their revenue position. But central government, yes, was able to perform probably better than expected given all the pandemic-related disruptions. I think the key over here, India's public debt or public balance sheet is definitely weak, and we acknowledge that fact that given public debt to GDP numbers are probably the highest, especially in similarly rated economies. But I think the key over here would be if we get this growth cycle going and then tax buoyancy sustains, then tax to GDP ratios, which have not really done anything in the last 10 years, will go higher, and that will open up the room for this improvement in mix of spending, and also at the same time continuing on a slow-paced fiscal consolidation path. So I think I would say that government capex should probably continue at the same sort of pace, at least what they're budgeting for. And then the growth cycle will help to sort of ensure that, we don't really see a ballooning of fiscal concerns.
Okay, the other, one of the big legs to your theory is that India's personal private final consumption expenditure did not do too badly. In fact, that did well. Now, 2 points. First of all, you have brought your own GDP forecast down for the current year from 7.2. You're saying that there is a 40 basis downside, which means 6.8. And even this private final consumption expenditure is very good in urban areas, but we are not seeing rural wages rise, and rural real wages because of inflation is actually lower. So do you think you can be that sure of a demand push to capex?
On the consumption or GDP numbers, we have lowered it to 7% from 7.2. The entire drag, I think, is mainly from the net export or the external weakness side, which was more than what we were expecting. So the future outlook trajectory or our quarterly numbers after June quarter have not really seen any major revision. So it's primarily a mark-to-market. And as I mentioned, the internals did not make us very nervous about the domestic demand story. On the private consumption side, yes, I think there has been an improvement, a lot of support from urban demand coming in, and rural has been sort of weak to range bound. I think what we think is will support the rural sector, and probably it should start getting reflected now, is that the whole reopening effect of the economy, which will probably support and should improve the support for the informal or the unorganized sectors, which have not really participated in the recovery in the last till now as such. So I think if you see the PMI services numbers, such as they are tracking above PMI manufacturing, and anecdotally also I think there's a lot of spending that's happening on areas which were impacted by the pandemic, and which would be like basically the trade, hotel, restaurants, which were also be employing a larger chunk of the unorganized informal sector. So I think this shift or this trickle through will happen, and we'll probably see it more in the numbers going forward, given that now it's been in the base in the last 3 to 4 months now.
Okay, actually out of time now, Upasana, but I just have to add a last question, which may be an unfair question to you. Your report, which has also been contributed to by Rhythm and probably the capital goods guys, says that your earnings growth of Indian companies can be a 25% CAGR in the next 4 years. The market is standing at between 15 and 16% for the current year. Last year was a good 39, but this year is like 15, 16, and next year also, the numbers I hear are 14, 15. This is a huge number you are forecasting. Any comments?
No, so Rhythm mentions that profit to GDP has gone down. It troughed at 2%. It's tracking around 3.5% to 4% now, and it should go above probably the previous peaks. So he thinks that this number will come through, given that what we are seeing from an investment rate. So investments will feed into higher corporate profits. And I think for the current year, the estimates that Morgan Stanley has for earnings are probably in line to a tad below consensus expectations. So I think there is that match for the current year at least.
Okay, we hope Rhythm is right and the consensus is wrong. And a 25% CAGR for 4 years is like music to our ears. Thank you very much indeed, Upasana, for joining us with your thoughts. We wrap up on Bazaar on a high note, both in terms of sentiment and share prices. Chartbusters up next.